Most high earning realtors think they are doing everything right on taxes, and the truth is, they are not. There is a section of the tax code that almost no CPA brings up to their realtor clients. And if you're making 200, 300, 400K a year in commissions, it's costing you 40K to 50K every single year. I know because I ran the numbers on my own business. Last year, I made multiple six figures as a realtor after I found the strategy, even just one property, one cost seg study, I cut my tax bill by over 60% the same year, legally, audit proof, using the tax code exactly the way it was designed to work. In this video, I'm going to walk through exactly how I did it, real numbers, real strategy. I will show you an alternative path if you cannot qualify for the main one. By the end of this, you're going to want to run your own numbers. Let me start with the problem quickly because most realtors underestimate how bad it actually is. As a self-employed realtor, you pay both sides of Social Security and Medicare tax. That's 15.3% off the top before federal income tax even touches your money. On $300,000, that's roughly 42K in self-employment tax alone. Add federal brackets, state taxes, and you're easily handing 90K to 100K to the government every year. Most realtors call their CPA, stretch their business expenses as far as they can, their car, their home office, marketing, and they call it a day. That's fine, but it leaves massive money on the table because there's a strategy that can cut your taxable income nearly in half, and it has nothing to do with your business expenses. The strategy is called real estate professional status, REPS for short. That's what I call it. So here's the concept. The IRS classifies most real estate losses as passive losses. If you own a rental property that shows a loss on paper, you normally cannot use that loss to offset your active income, your commissions, your sales checks. REPS changes that. If you qualify, your real estate losses become active losses, and active losses can be used directly to offset your active income. So if you're making 300K in commissions and you have 135K in real estate losses, which we'll dive into, you're now showing 165K in taxable income. That's a massive difference. Here's why realtors are uniquely positioned for this. To qualify for real estate professional status, the IRS requires two things. First, you spend more than 750 hours per year in real estate activities. Second, you spend more time in real estate than in any other profession. For most people, that second requirement is the hard part. But if you're a full-time realtor, you're already logging 2,000, 3,000, probably more hours a year in real estate, right? You likely qualify right now and you don't even know it. Now, here's something that almost no one talks about. You don't have to be the reps qualifier yourself. So let's say you're married, you file jointly, your spouse can be the one who qualifies for reps. That means if you are the breadwinner with, let's say, a high W-2 or a high commission income, and your spouse is the one managing your real estate portfolio, logging the hours, their rep status applies to your joint return. Guys, this is where the hack becomes unreal. The losses still offset your active income. The tax benefit is the same. This opens the door for a lot of households that assume they can't qualify because the high earner is too busy, right? The high earner does not have to be real estate professional. The key in all of this is documentation. Whoever is claiming real estate professional status needs to track their hours and keep a log that their CPA can defend. But the qualification itself, done correctly, is very achievable. And it comes out to be like 14 and a half hours a week. So now you know the door, but real estate professional status alone does not save you 40, 50 grand in taxes. It's what I'm going to talk about next is what actually does it. And that is cost segregation. When you buy a property, the IRS lets you depreciate it over time. A residential property depreciates over 27 and a half years. You buy a $450,000 building, you write off roughly 16K a year. That's decent, right? Cost segregation is different. Cost segregation study breaks your property down into components, the flooring, the fixture, landscaping, electrical system, and reclassifies them into shorter depreciation schedules, 5 years, 7 years, 15 years, instead of 27 and a half years. And thanks to bonus depreciation rules, you can accelerate a large chunk of that depreciation into year one. Here's what that looks like in real numbers. You buy a $650,000 duplex. Let's say the land is worth $200,000. Can't depreciate the land, so you depreciate the building value, which is $450,000. A cost segregation study identifies that 30% of that building, $135,000, can be reclassified into accelerated depreciation categories. With bonus depreciation, you write off that entire 135 grand in year one. Now back to our realtor making $300,000. They buy this duplex, they run a cost seg study, and suddenly they have 135K in paper losses. That's on top of their other business expenses they're writing off. 300K minus 135K equals 165K taxable income. We're going to ignore the other business expenses for now. At a 35% effective tax rate, that's roughly $47,000 in tax savings from one property, right? And you can do this over and over again. That's exactly what I do. And the property, it's still there. It's still cash flowing. It's still appreciating, still building equity. You did not spend $135,000. That's a paper loss created by the tax code. The asset is real. There's a lot of people that do this with Raptors, right? They buy a F-150, $100,000 and write off their income. It does the same concept here, but guess what? It's depreciating in value. It doesn't give you money. You're spending money to save less in taxes. Whereas real estate, in this cost seg example, you're buying assets to save in taxes. Much, much better. Now, I know that some of you are thinking, I'm not a full-time realtor. I have a W-2 job. I cannot qualify for reps. Fair. Now, here's the alternative, and this one is genuinely wild. It's called the short-term rental loophole. The IRS has a specific rule. If the average guest stay at your rental property is 7 days or less, that property is not subject to passive activity rules. It does not matter if you have reps or not. That means the losses from a short-term rental, an Airbnb, VRBO, can offset your active income as long as you materially participate in the management of that property. 100 plus hours in that year. Material participation means you are actively involved, managing bookings, handling guest communication, overseeing the property. The IRS has specific tests for this, and your CPA can help you document it. But the result is the same. You buy a short-term rental, you run a cost seg study, you generate paper losses, and those losses come directly off your taxable income. This is the go-to strategy for high earners who cannot qualify for real estate professional status. Doctors, attorneys, W-2 employees making 300, 400, 500K a year. This is how they are legally reducing their tax bills while building real estate portfolios at the same time. The key word in all of this is documentation. Track your hours, track your involvement, and work with a CPA who actually understands real estate. Most do not. And that is not me being harsh. It's just the reality of this industry. I've tried several. Let me bring it all together. Before, you're making 300K as a realtor. After expenses, you're showing 300K in taxable income. Your tax bill, self-employment, federal, state, is somewhere around 90 to 100K. After you buy a 650K duplex, you run a cost seg study, you identify 135K in accelerated depreciation, you qualify for real estate professional status because you're a full-time realtor. Your taxable income drops to 165,000. Your tax bill drops by 40 to 50K, potentially more depending on your state and how much you bought in real estate, right? And here's the part most realtors miss. You still have the property. The 135K was not cash you spent. It was a paper loss created by the tax code. The duplex is still sitting there, cash flowing, appreciating, building equity. You save 47K in taxes and you acquired a real asset. That's a double win that most high earning realtors never figure out. And just a little tidbit I'll throw in here. You can even add this back into your income when it comes time to buying a house or your lendability. So it's not hurting you in that sense. I'm not a CPA. I'm not a tax attorney. I'm a realtor and investor who has run this strategy personally and helped clients run it too. I make this content because I talk to high earning realtors every week who are handing money to the government they do not have to hand over, not because they're doing anything wrong, because no one told them that this was an option. If you're making 200, 300, 400K a year and you're not doing this, run your own numbers. Talk to a CPA who specializes in real estate, not just any CPA. And if you want to run through this together, your income, your scenario, what a property purchase would actually do for your tax bill, I do strategy calls. The link is in my description. We will look at your actual numbers and figure out if it makes sense for you. If this helps, drop a comment below. I read every single one. And if you're a realtor getting crushed on taxes who has no idea this exists, send this to them. It could save them tens of thousands of dollars. I'll see you on the next one.